Hey guys, thanks for requesting the video on the renovation loans. If you're here, you've probably have some interest in either buying a home via a 2 or 3K loan, a renovation loan, a rehab loan, something like that. One of the key points that you probably have in mind is you're seeing all the homes that are out there on the market, realizing that you can probably even get a better deal on a home that needs a little bit of work. So what we're going to do right here, Andrea and I are going to go over some of the key points, frequently asked questions, some of the steps that are actually required and needed on your end to get a 2 or 3K, and some of the tips, tricks, strategies and such that'll help you out through the process. So you want to kick this off? That'd be great.
Well, great. Well, Jason, I know you're a specialist in this area. You've been working this product for a number of years. You kind of came out of the gate ahead of people, so we're lucky to have you on our team as a specialist that can really answer questions that other people are kind of finding out by the School of Hard Knocks, which is a lot of what happens, unfortunately, in lending. But I know I'm full of questions right now. I'm really anxious to get into this with you. So my first real question is there like a minimum amount of work that has to be done? And at the same time, is there sort of a maximum? Because I know there are construction loans that you're building a house from the ground up, but is there a minimum I have to do to my house to make it qualify for this loan? And is there sort of a maximum amount you would lend me to make repairs?
It's actually a great point, and the pure answer is no. But first and foremost, there's two types of products for a 2 or 3K. Well, there's two types of transactions in which you can use a 2 or 3K. You can use a 2 or 3K, which is actually the code, the Federal Housing Administration code, which relates to a renovation loan. And that being said, a 2 or 3K is part of an FHA loan, as I just said, so we'll get into that. But you can use this program on a purchasing of a property as well as the refinancing of an existing home. So that being said, the typical amount of work that's, I want to say, not suggested or required or what have you, but generally you see $5,000 as the minimum. And that has more to do with the fact that there are extra fees that are involved in a 2 or 3K loan than there is in a normal FHA loan. A standard FHA loan is considered what's called a 203B. But 2 or 3K is the renovation loan. So K, construction, you kind of think of it that way, even though it's not spelled that way, just the way that a lot of people remember. But so think $5,000, and again, that has more to do with the fact that when you're doing a renovation loan, there are extra costs that are involved, and the reason being, you're bringing in a completely separate group. You're bringing in a group of contractors, and you're also bringing in multiple checks that are cut, draws, inspections, those sort of things, which all of that adds up to a little bit extra as far as cost, which is where the $5,000 figure comes from. But to dial it even more down, there's two types of 2 and 3K loans. There's one that's called a streamline and one that's called a full. Streamline, as the name sort of alludes to, is the fact that it's more of a streamlined program. It's generally $5,000 to $30,000 to $35,000. The actual number is 35, but a lot of people bring it down to 30, and that has more to do with the fact that you have some tolerances that are built into there as well. So if you had $35,000 worth of rehab work, you would actually end up being above that because of the typical 10% holdback that they have. So that being said, think like $5,000 to $30,000. And it's also going to be for non-structural, more cosmetic type things. Paint, paper, floors. A couple things to think of that you can't do. You can't do structural. Can't have a mold issue. Can't have anything like that because the mold could undermine the structural integrity. Can't do landscaping. Can't do luxury items. But generally, to a great degree, kitchen, plumbing, those sort of things, electrical, great, streamline, fantastic. Structurally, can't move a load-bearing wall on a streamline, but it's just more of the easier, quick fix kind of things. The full basically lets you do, to a great degree, anything other than luxury. They don't like to do luxury either way, and that means you're not going to be able to get a hot tub thrown on your renovation loan. But then also landscaping, that's another area that they don't like to have a lot of. There are some, but very limited as far as what you can do on a 2 or 3K. But as far as dollar figures on a full, no, I have 2 fulls right now that are both over $100,000 in rehab right now. So it's more on the type of work to which one you'd be dealt on. A lot of people think the full went away, and the full has never gone away. It's always been around. And we've mentioned this on a couple of the other videos. It may have to do more with who the messenger is, more so than the program. So a lot of lenders and a lot of, definitely the broker world, they don't do or can't do the full anymore. So, but it's there, it's doable, it's alive and well. But it has more to do with, again, the type of loan. And again, purchase to refi, very similar as far as what it's set up, but you can do dollar figures generally from $5,000 and up.
Well, I can really see just from your answer to that question, it's so important to have a specialist on your side because
Completely.
it sounds like a loan with a lot of moving parts.
Mm-hmm.
And I have years of experience in this industry,
Sure.
and there's some complexity to this that
Yeah.
you just don't come across in a regular loan. So,
Oh, completely.
if nothing else, we want our watchers to know you really need to find somebody who this is not their first rodeo.
Yes,
You know,
well, we talk about time frame on some of these. General time frame on a standard 2 or 3K loan is under a month. But we've had other situations where we just, again, 40 years between both of us as far as experience, and some places where you're looking at 90 plus days. And either whether that's a refinance or a purchase, that's just not a time frame that's all that exciting to be walking into. So, and that has more to do with the parties and the security of the people that are around you. So,
Sure.
Great point.
So now, are there? You said that this is an FHA product. So
Correct.
then, do we just really follow the FHA's rules in general, or are there differences between what I need to document this loan, or are there differences to the rates? What makes this? What makes a K versus a 203B different?
Well, you know what? I'll go with the similarities, and I'll tell you the difference. The similarities in the first end, 3.5% down, just like a normal FHA, which is fantastic when
So
you
when
think
you
of this.
say 3.5, does that include my repairs?
Yes.
Or, okay.
So if you have a home that you're buying, let's say it's a home that's a $300,000 loan. Let's say it's a $200,000 loan, home with $100,000 worth of rehab.
Okay.
So $300,000 into the property. $300,000 into the property, 3.5% down is your down payment.
Wonderful.
So you have $10,500 as your down payment. Now the thing that's interesting, if you compare this, you have a $200,000 home that when you run it, it's $7,000. So you can buy a home for $200,000, your down payment's $7,000. You can buy a home for $200 and put $100 into it, and your down payment's $10,500. So for $3,500, you're getting essentially $96,500 extra to work on the house.
Right.
And obviously it has to make sure the value's there and such. But that's the similarity, 3.5% down. Fees and such, again, similar. There are additional ones for the construction loan, not the construction, the renovation loan. And that has to do with, again, if you're having 4 draws, you're going to have 4 inspections to make certain that when money is getting cut, that there isn't a mechanic's lien on the home, or the work's actually completed, so somebody has to get out there and do that. Other than that, as far as the differences and such, really a normal loan has to do with approving a borrower and approving a property. So approving a borrower, which we'll get into, is we take a look at your credit profile, your income, your assets, your down payment, those sort of things. We look at the type of property, single family, 2-family, condo, you can do it on condos. But when you look at a 2 or 3K, you take those, and then you also now bring in a contractor. So you need to make sure now you have a separate party where now the contractor has to be approved. And generally they're not going to make certain that the guy is squeaky clean to every degree. What they really want to know is they want to make sure this person's going to have the ability to take these funds and not run off with them.
Sure.
So to a great degree. That's not to say if someone is denied for a 2 or 3K that somebody has decided that they're going to run off with your money. It just is another approval step that they look for. But that's generally what they're looking for. It takes a little bit more because you have to have that approval. But as far as the program itself, pretty much follows the FHA guidelines to a great degree, which is why it's so valuable.
Well, it sounds great, and I'm thinking the only really option a consumer would have would be something like an equity line,
Completely.
where their rate's going to be
Completely.
subject to change, and their payments could be all over the place. So this really is just locking
Sure.
them in, and even compared to construction loan, this is one time you
Completely.
close it, you're done,
Completely.
you make your repairs.
Yeah.
So
Well, the
that's
other
really,
thing too, you think of that 200 versus that 300 scenario. The other benefit of an FHA loan is they're going to look at what's called the after repaired value. So if you have a $200,000 home with $100,000 worth of rehab, my guess is it's going to be worth more than $300. That would be the
Sure.
home. Otherwise, you may want to look at some of the work that you're having done. So that being said, with a 2 or 3K loan, they're going to take a look at the after repaired value, and that's what they're going to go off their numbers for.
Wow.
Plus, they also have the ability to go off of 110% of the value. So you can have more flexibility in that respect. So it's huge because comparatively, you have a $200,000 house that needs a bunch of work. And then the other side, you have a 200, which is the one where you get a home equity line.
Sure.
So then, you're not going to be able to get a home equity line if you just bought the home with an FHA loan. You don't have any equity. You only have 3.5% down.
Right.
Home equity lines are not excited about giving you money on a home that technically has nothing for insecurity. With a 2 or 3K, you are able to take that after repaired value. So they have an as-is value of 200 and an after repaired value of, let's say, 350. And we've had situations like that where it's been that pronounced. I had very similar actually. Bought it for 200, put 120. It was 116, 120 into the home, into it for 320. home at the time of the approval, the appraisal came out and it came in just over $400,000.
Wow.
So mind you, $120,000 is a lot of rehab. But for buying it for $2, putting in $120, being into it for $320, and having a value of $4, they're walking into $80,000. And the thing that's great about that is when you compare it, more importantly, the down payment still is off that $320.
It's amazing.
So it's still just like $11,000 some odd dollars or $12,000 some odd dollars to get the $80,000 of equity. So
You know, I'm thinking back to the days when I sold real estate, when you
Yep.
had the first-time buyer come in and you'd go through the house and they'll be like, we'll change that, we'll change that,
Right,
we'll change that.
right.
And 7 years
Right.
later, I'd go back to sell the property
Right.
for them and it would look just like the day I sold
Right,
it to them.
right,
So, because
right.
truthfully, we just don't have those kind of cash reserves to make $100,000
Right,
worth of repairs.
right. Well, if you're buying a home via FHA, you're buying it because you typically don't have a big down payment.
Sure.
So if you typically don't have a big down payment and you haven't been saving $50,000 on your own end over the years, with all due respect, what's the likelihood of you all of a sudden coming up with
Absolutely.
$50,000?
Yeah.
So it is a fantastic program that's out there for that reason. Rates are a little bit higher than the normal FHA loan, anywhere from 1/4, maybe to 0.5%. But again, when you compare those scenarios, it's a world of difference in the positive sense as far as going FHA.
Well, you know, I've even heard stories where this could save a loan. Like, I heard an example about a property where the septic failed. Well, tell me, how would that work? You know, if the borrower started out just pursuing a regular
Sure.
FHA loan, how
Sure.
could we then use this as a vehicle
Sure.
to help in a situation like that?
That is, unfortunately, that's something that's pretty common, where something will come up, and whether or not it's a septic or something that's as identifiable as the septic system, or just the condition of a property, a bank-owned
Like
property.
a home inspection gone bad type
Exactly,
thing.
right. A home inspection ended up going bad, termites, mold, or septic, something like that. Or a home that you already know is beat up, and you know it's going to need new windows, new this, new insulation. Or a home, which is what I probably hear as much, where love the home, love everything about the home. It's in the best place in the world, awesome school district, awesome situation, awesome setting. The house has not been touched in 40 years.
Sure.
So
Just
that's the
general
situation.
maintenance.
Exactly. So we needed a new kitchen, we needed this, we needed that. $25,000 will mean a world of difference with regard to that home. So, but on that situation, using a septic, excuse me, what ends up happening is, if you're an FHA loan, it's even easier. But basically, if we have an FHA loan, we'll then flip it to a 2 or 3K loan, which means change it to a 2 or 3K loan. And then what would end up happening in the seller's eyes is really not a difference, unless you then go back and renegotiate a discount because the septic now is failed.
Sure.
But let's just say, for sake of example, there is no change. So what ends up happening is you end up getting a bid as far as what work is needed. So the septic, $9,000, let's say.
Yep.
Septic is done, the inspection is done, the bids are done. That is now part of the package. Whoever's going to do the work, the septic company then is approved. That's taken care of. Everything else is the same. It's still 3% down,
Yeah.
Now, what typically has happened, though, you'll have whatever the figure is, $10,000 now added onto the loan. But now you have a brand new septic. And
Sure.
again, you may be getting that on the other side taken off. But it is such a deal saver in that respect. But then also, again, this is where the refinancing is such a key point too. I have actually a high school friend of mine who's doing a 2 or 3K, full 2 or 3K refinance. In this environment, selling your home isn't as easy as it has been in the past.
Sure.
Safe to say, politically correct.
Yeah.
So that being said, his situation is, as a growing family, great location, loves the location, the house is just so small. So what he's able to do is he has the home, he's refinancing the home in a 2 or 3K and adding on, it's going to be 1.5 times his house right now, adding in a good size addition, 3 floors, foundation all the way up, and it's going to now end up with a new FHA 2 or 3K loan with all those improvements taken care of. But in the sense of a borrower, the borrower just has to realize it's a FHA loan. At the end of the day, it's an FHA loan. At the end of the day, when you're a year into it making your payments, it's an FHA loan. So,
And you could streamline, refinance it the way you
completely.
would.
That's a great point with regard to the FHA streamlining, because what ultimately ends up happening there, what FHA allows you to do is, if you have an FHA loan, you can then refinance that FHA loan under don't be confused with the 2 or 3K streamline, but it's literally called an FHA streamline. And what it lets you do is, for very limited documentation, whether or not it's no appraisal, no income, no assets, you can generally just have the interest rate dropped on your old FHA loan by refinancing it into a new FHA loan. So.
Well, and you said, it starts out with maybe a slightly higher rate, so
Sure,
you might be able to do these repairs, if I'm
Sure.
understanding you,
Yeah,
and
year
then maybe
past.
shortly down the
Yep,
road, once
completely.
everything's done, refinance
Completely.
to the better rates.
Completely.
But that's like having your cake and eating it too.
Completely. It's so, and again, the end result is I would joke when I'm at the table, and I always joke by saying to the wife versus the husband, because the husband, myself included, has all these grand ambitions about going to do this, the other thing. And then the question would be, do you want to have the work done now? Or do you want to have the work done over the next 10, 15 years? And like you said, how many times really is it ever done?
Well, and how many times do you see a homeowner going and putting all that money in to put it on the market and never getting to enjoy the benefits that they've made? You know, they go and put wall-to-wall carpet so they can sell it.
Sure,
and so,
because they know the buyer is going to catch it. So they know that that's not going. You're not going to be able to sell it because of that, and so then they rehab it and fix it, and then they sell it within the year. So
right. Well, and that reminds me, in our package, we do have a list of approximate return you would get for particular repairs. So if you are thinking about a new kitchen, a new bathroom, it will give you an idea of what kind of return you could expect on those items. So before you go and put too much money in, you do want to make sure you're going to get some return. Obviously, things like a septic you have to have. It's not optional, but you might want to just take a look at that information before you decide on what repairs to make.
Well, even just the fact of bedrooms to bathrooms, the square footage and those sort of things. If you're looking to add a third floor, unfinished third floor, or even just an open room versus rehabbing your kitchen or even adding a bedroom and a bath. So those are such key points because it literally just comes down to those dollars that you're taking out of your pocket and you're putting back into it, and it's going to come right back to you. So.
Well, and right now it seems like a better investment if you could build yourself $100,000. I think it was in equity your friend built up. You're certainly not going to do that on the stock market right now. So.
Well, it's in every situation too. I just recently had it in a condo. To give an example, I had a situation where a bar was buying a condo for just over $90,000, and there was a flood. It was over the winter, so. We joke that when the spring comes, you get all your water deals, your flood deals, because all the pipes pop or what have you within this condo, within properties. So a homeowner bought the home for $90,000, needed $8,500 worth of repairs. Now, listen when I say the $8,500 had $3,500 worth of plumbing work, about $1,500 worth of miscellaneous work, and then all new appliances. Because you can finance appliances into this as well.
Wonderful.
So it was washer, dryer, fridge, stove, plus miscellaneous plus plumbing work, $8,500. Bought it for $90,000, put $85,000 into it, so it was in it for $98,500. As is appraisal was $125,000.
Oh my word!
So she literally put in just about $3,000 into this house and walked in with $27,000 worth of equity. So, and at that number, you look at that's like 30%. It's significant. So,
I mean, you really need to encourage consumers to take a look at some of these bank-owned properties because there really are some chances to build some equity in a market where it's otherwise going to be slow going at best.
Completely. So,
Jason, can you think of anything else specifically about a 203K that we should let our viewers know? Is there anything that comes to your mind that we should bring to their attention, or do you think we pretty much have covered kind of the high overview of this product?
I think we did. Well, you brought up in the front end, which is the best thing to do. It is such a moving product. There are a lot of moving parts. So I would say the biggest thing is to reach out to us if you have interest in obtaining this kind of loan or exploring it or want to see if it fits for you, whether or not you're buying or refinancing. So that's the biggest part. But as far as the particulars and such, really, I think we gave a good overview, and then the nuances and such would have to do with what your particular situation looks like. So,
clearly, every one of these deals is different. So you have to, you really need to. If ever it's important, a specialist is the guy you need on your side. And Jason, we're again glad to have you on that team. I'm thinking about my ugly kitchen cabinets. It's time to get rid of them. So maybe we'll talk later.
It's a good point. It's a great point. So yeah, honestly, any questions you guys have, anything you want to run by your particular scenario, obviously feel free to reach out to us. There's contact information after this video, so we'd love to help you out and get you either onto a nice new home or fix up your old home.
Well, great. And again, I'm Andrea Baldwin. This is Jason Perry with Annie Mac Home Mortgage, and we look forward to talking with you soon.
Thank you.